I'm Judy Shaw for The Exchange. Joining me today is Ragen Stienke. He is the founder and CEO and portfolio manager at Ballast Asset Management. Ragen, it's great to see you. Thanks for joining me.
Absolutely. Great to be here, Judy.
Now, quick note to our viewers, this interview is for informational purposes only. The NYSE doesn't recommend any investments or investment strategies. All right, so Ragen, small and mid-cap value segments appear to have been out of favor for growth. What is your outlook for value investing? And more specifically, why do you believe MGMT provides a solution to help investors compound their capital?
Absolutely. Two great questions. And you're right. Value really has been outrun by growth throughout this entire last business cycle. To the point where the performance differential and the valuation differential between small cap value and large cap growth is as high as it's been since the dot-com bubble. And we believe that you're going to see a reversion that will be not just quarters, but a multi-year reversion. And we believe that the Ballast Mid strategy and MGMT specifically will benefit from that for two reasons on the compounding front. Number one, because of our focus on downside protection. And we really focus on avoiding the big parts of drawdowns during times of market dislocation. So that's one. Secondly, is looking for high quality companies that you are buying that have cash flow and income that you're buying for attractive valuations. And when you combine those two things, A, not digging too big of a hole during the downturns, and B, compounding those cash flows over time, we think that our investors will be handsomely rewarded for that.
Describe the characteristics which, in your view, separate good management teams from great ones.
It's a great question. So we look for three primary things when we're looking at management. We look for integrity, alignment, and fit. So it starts with alignment. And to evaluate that, we're looking for management teams that deploy capital at very high rates of return and then get paid based on how good they were at doing that, right? That's the alignment with us as shareholders. The second is integrity. And this is where we evaluate we call it the say-do ratio, right? Where we're really looking for not only what they tell us they're going to do and tell the market what they're going to do, but then evaluate if they actually did it. And the final thing that we look for is the right fit. Because just like a hammer is not the best tool for every job, a particular CEO or management team might not be the right fit for the particular company at that point in the life cycle. And so, for instance, we wouldn't want a CEO who was great at turnaround stories when we're investing in a company that really needs a CEO that needs to grow the business. And the inverse is also true.
How does MGMT differ from other small to mid-cap value equity strategies available to investors?
Well, number one, it's actively managed, right? So we took our same strategy that we've managed for over 17 or 18 years. I've had experience managing. And secondly, that we're extraordinarily disciplined in applying that downside analysis with our upside analysis. So we determine what we believe the ultimate risk is, and then we look for what the benefits are over time, what we think the company is worth on a 3-year view, and then identifying optionality. And much like the word optionality or option implies, it's something that could be really big, but it's too risky to pay for, right? And so we want to buy that. We want to get that for free in the businesses that we own. And then very simply, we marry those two bits of analysis such that we have a downside and an upside. We call that a reward to risk ratio. And we're looking for asymmetry of at least 3 to 1 or greater, right? And we just want to be, our process is very focused on just executing on that asymmetry over and over and over again. And it depends on that risk reward differential rather than just our ability to be right all the time.
All right, so Ragen, what's your outlook for value investing? And more specifically, why do you believe MGMT provides a solution to help investors compound their capital?
Yeah, so we think that value is at a historic differential, both in terms of the performance that it's seen and ultimately the valuation differential with large cap growth. And we haven't seen this since the dot-com bubble. And so we think that we're in for a multi-year cycle where we're going to get a reversion of small cap value beating large cap growth. And we think that we are perfectly positioned for that.
What are the primary data points you look at, given the concerns that inflation may be increasing that others may not be looking at?
So I think there's two parts of inflation, right? Number one, there's the inflation that's being caused by the supply chain difficulties. And those are all of the things that are talked about every day throughout the media. The piece that I think that is missing is the inflation that is tied to the push to go to net zero carbon. Right? And so as we transition from traditional production of energy, which was heavily reliant on fossil fuels, to renewable energy, there's an enormous capital cost that comes with that. I've seen estimates upwards of $6 trillion in order to move the US completely to renewable energy. And the problem is that the value of a coal-fired power plant or a nuclear power plant, when it's not producing electricity, is zero, or perhaps even something less than zero. And so all of the costs that are going into building out renewable energy are ultimately going to have to generate returns for the investors who are investing in that. And we believe that that's going to be passed through to us as consumers, not only directly in heating and cooling our homes, but into all of the things that we consume. And so we believe that that is a more sustainable inflation that will be here, not just for quarters, but for years and perhaps the next decade.
All right, what do you believe inflation means for small and mid-sized companies, and are they better positioned or at greater risk?
I think that inflation is less of a risk, or the risk is less to do with the size of the business and more to do with the business that you're in and the products that you make. So just to give you an example, if you're in an industry and your business is it's very fragmented, it produces a product that is readily substitutable or is not necessary, right, then inflation is going to be a problem, regardless of the size of your business. So think of things like grocery stores, right, where you can easily substitute one product for another or go to another grocery store. We're looking for businesses that have pricing power, and that gets used a lot. And so what does that mean? It means that they either have a combination of they're a dominant player within a market, right? There is no easily substitutable product, and you need it. And so think of a software company as a for instance. I mean, can we imagine not using Microsoft in our daily lives? And so Microsoft is going to have the ability to pass along pricing, and the businesses that we invest in have similar traits.
Okay, and finally, Ragen, how do you position this fund for this environment, and how do you think it'll perform?
So we're positioned for worried about inflation, right? And it turns out that the same things that work in that environment are what we already do. So we buy high quality businesses, and by that we mean businesses that are generating, as I said, income and cash flow, that earn a high return on the invested capital, where there is a great management team in place, and where they have pricing power such that they can defend themselves if we are right and inflation is here to stay.
Okay, Ragen, it's been wonderful to talk with you. Thanks for joining me on The Exchange.
Thank you, Judy.